BINC crushed BNDX over 5 years, a 22% gain versus a 1.2% loss. That's a massive 23-point performance gap. BINC crushed BNDX over 3 years, 22% versus just 15%. That's a 7-point gap that really matters. But here's where it gets interesting. BNDX managed just 15% over 3 years, lagging by 7 points. That's a red flag you can't ignore in bond performance. In plain English, BINC lapped BNDX multiple times on the same track. That's the performance gap we're talking about. One fund's engine delivers consistent power, while the other just sputters along behind. But here's where it gets interesting. BINC's 7% return over the past year shows consistency you can count on when you need reliable income streams. Here's where the story takes a turn. BNDX's 2.8% return barely outpaces inflation. You're essentially treading water, not making real progress on your investment goals here. Let's break this down further. BINC's 1.3 Sharpe ratio means you're getting solid returns without taking crazy risks. That's the sweet spot investors want. In plain English, think of Sharpe ratio as your investment report card. Higher scores mean you're getting better returns for the risk you're taking. BINC earns an A, while BNDX barely scrapes by with a passing grade. Now for the real question. A 0.3 Sharpe ratio over 3 years? That's terrible risk-adjusted performance. You're barely getting paid for the volatility you're enduring. Let's dig into the details. BINC's 1.8 Sortino ratio shows strong returns relative to downside volatility, meaning you're getting rewarded well for the actual risk taken. Here's where things get revealing. BNDX's Sortino ratio of just 0.5 shows poor risk-adjusted returns. Even accounting for downside volatility alone, it's struggling to deliver meaningful performance. In plain English, Sortino ratio is like storm brewing. It only measures the bad storms, the downside volatility that hurts you. BINC's strength? It stays calm when markets panic and others lose their heads. But wait, there's more to this story. BINC's 0.1 alpha means it's actually beating expectations, delivering returns above what the benchmark predicted over 3 years. Here's the thing, though. 0 alpha means you're getting pure index returns. BNDX tracks its benchmark perfectly, nothing extra added or lost here. Let's take a closer look. BNDX's worst drop hit 16% over 5 years. That's devastating when you're counting on stable income in retirement. In plain English, maximum drawdowns like a roller coaster's steepest plunge. It shows your worst fall before recovery. BNDX takes a wild drop, while BINC stays smooth and steady on the ride. But that's not the whole picture. A 2.4% maximum drawdown over 5 years means your money stayed remarkably stable, practically unheard of for income investments. Let's see how this plays out. Sure, it bounced back in 15 days, but recovering quickly from a catastrophic fall doesn't undo the damage already done. Here's what really matters. BINC's 35-day recovery from a shallow drop beats competitors who recover fast from massive losses. That's smart risk management right there. In plain English, here's the stairs descending lesson. Recovering fast from a brutal 10-step crash doesn't erase the damage. BINC stayed steady, avoiding the big plunge entirely. That's real protection. But hold on a second. BINC's 6% dividend yield lets retirees live off income without selling shares. That's the dream for reliable cash flow. All right, pause here. Who's your winner? Drop BNDX or BINC in the comments below. Here's the key takeaway. BNDX offers a respectable 4.4% yield, but it's trailing BINC by 1.6 percentage points. That's a meaningful income gap. In plain English, dividend yields like finding couch change monthly. BINC keeps discovering coins between the cushions without you lifting a finger. Higher yield means steady income without selling a single share. But there's a catch. BINC's worst year ever, just 0.02% positive. Basically flat, but it still beats losing money when markets crash. Let's get into the weeds here. That 13% drop erased nearly 3 years' worth of dividend payments. Bonds aren't always the safe haven you'd expect. Now, let's shift gears and look at BINC's worst year barely broke even, while BNDX cratered 13%. That's the difference between sleeping well and panic selling. In plain English, here's the sleep through the storm difference. BINC lets you rest easy when markets crash, while BNDX keeps you up at night watching your portfolio bleed. That's what worst year returns reveal. Let's zoom in on this. 3% volatility over 5 years means your retirement income stays predictable. No wild swings keeping you up at night. BNDX's nearly 5% volatility means you're riding bigger swings than most bond funds. Expect some restless nights watching those fluctuations. Here's where the story takes a turn. BINC's 3% volatility crushes. BNDX's 4.8%. That's 60% smoother, meaning your income stream won't swing wildly month to month. In plain English, volatility's like tightrope walking. BINC crosses steady while BNDX wobbles all over the place. Less wobble means you're not holding your breath every market swing. Steadier sleep, steadier returns. Here's where the story takes a turn. At just 0.07% annually, BNDX keeps more money in your pocket. That's the beauty of passive index tracking right there. Now for the real question. At 0.4%, you're paying a bit more for active management. Worth it if the fund's performance actually delivers. In plain English, think of expense ratios like a car engine. BNDX runs stock, while BINC pays a mechanic to tune yours for peak performance. Sometimes that extra cost delivers real horsepower. Here's where things get revealing. BINC's dominating across the board. 22% 5-year gains versus BNDX's loss, a stellar 1.3 Sharpe ratio with minimal drawdown, plus 6% yield while keeping your capital intact. That's a clean sweep. Now let's put this in perspective. BINC charges 0.33% more annually, yet crushed BNDX by 23 percentage points over 5 years. Sometimes you get what you pay for. But wait, there's more to this story. BINC's 22% gains with 0.4% fees crushed BNDX's negative returns. Sometimes paying more for active management actually pays off. Here's the thing, though. BNDX owns 6,600 different bonds. That's diversification cranked to the absolute max, making any single position nearly invisible. In plain English, BNDX, slices its pizza into nearly 7,000 pieces, while BINC cuts just under 4,000. More holdings means better diversification. If one bond defaults, you'll barely feel it. Now here's where it gets tricky. BINC holds nearly 4,000 bonds. That's concentrated enough for active management to work, yet diversified enough to spread your risk. But that's not the whole picture. BNDX keeps it simple. 98% pure bonds, nothing fancy. It's designed to track its index with laser-like precision and focus. Let's see how this plays out. BINC's holding 107% in bonds means they're using leverage, borrowing money to amplify returns. That's extra risk for extra reward. In plain English, think of it like an amplifier knob. BINC cranks the volume past 100% using borrowed cash to juice returns, while BNDX just plays it at normal levels. Leverage amplifies everything. Now, let's connect the dots. BINC achieved 22% returns with just 3% volatility using 107% allocation, proving smart leverage boosts gains while keeping risk remarkably low. But hold on a second. BNDX's negative 0.1 correlation to stocks means it barely moves opposite the market. Minimal diversification protection when you'd need it most. Let's unpack this a bit. BINC's 0.6 correlation means it's not your diversification hero. When stocks drop, expect BINC to slide too. In plain English, think of it like dance partners. BNDX moves independently, doing its own thing, while BINC syncs up with the stock market's every move. BINC trades diversification benefits for higher returns. Now let's flip the script. BINC's higher correlation paid off with 22% gains and minimal drops, while BNDX's diversification actually hurt returns here. But there's a catch. BINC claims victory on every front. Superior returns, smarter risk management, better income, and real capital protection. That's complete dominance across the board. Let's get into the weeds here. BNDX's low fees don't matter when you're losing money. 16% crashes prove cheap doesn't mean good for your portfolio. In plain English, BINC sweeps the victory domination here. Better returns, lower risk, higher income, and downside protection. BNDX's only win, a slightly lower expense ratio. That's it. But here's where it gets interesting. BINC's 0.1 alpha and 22% returns prove active bond management can beat passive strategies. This demolishes the index-only argument completely. Let's zoom in on this. Negative 5-year returns and 16% crashes. Low fees don't matter much when you're losing money year after year. Let's dig into the details. BINC delivers 6% yield with capital protection, beating alternatives offering just 4.4% with 13% losses. That's peace of mind. In plain English, BINC's the marathon runner here, pacing steady with energy reserves to finish strong, while BNDX sprints hard, then collapses. In long-term income investing, consistency always beats flashy bursts. Let's break this down further. That 23-point gap between BINC's 22% gain and BNDX's negative 1.2% shows you what active management can deliver. Now, here's where it gets tricky. BINC's Sharpe ratio of 1.3 crushes BNDX is 0.3, delivering superior returns with less risk. That's the winning formula investors dream about. Now for the real question. BINC's 2.4% max drop versus BNDX's 16% crash. That's the difference between sleeping soundly and losing a year's retirement income overnight. In plain English, here's capital protection explained. BNDX loses whole floors during market earthquakes, while BINC just cracks a window. Both buildings recover eventually, but you'll feel very different about the damage done. Here's where things get revealing. BINC dominates across returns, risk, income, and preservation. BNDX's only win, lower fees. That's a pretty lopsided victory here. Now let's put this in perspective. Here's the problem. Higher fees don't guarantee better returns. BINC got lucky this time, but that's not how fees work long term. But wait, there's more to this story. So which one's for you? BINC, if you want safety and income. BNDX, if you're chasing rock-bottom fees despite the pain. In plain English, BINC's like a seesaw that actually works, balancing safety with returns for retirees who need income and stability. BNDX, it tips you right off when markets get rough despite those rock-bottom fees. Let's take a closer look. The fine print matters. You're responsible for your own research and decisions here. Now, here's where it gets tricky. That's a wrap on this ETF battle. Hit subscribe for more data-driven breakdowns that cut through the marketing noise every week.